Welcome to the InterMarket Analysis Update. This is being prepared Monday, August 8th, where we'll look to see how the markets are interacting with each other, to look at those things that are positive, negative, and then see how things look going forward from here. So this is for Monday, August 8th. First of all, we look at the S&P 500 valuation. Now, this is a big long-term chart, but we like to look at this each week just to see how are we faring as far as the PE ratio, whether we're expensive, just about right, or considered cheap at this point. We've been battling back and forth between the PE 20, which when we're above 20, the market is considered to be expensive. We dropped down below that, and now with the advances that we've seen in the S&P 500, we continue to be above that level. The red line down below is just the gap between the S&P price and the PE 20 price. This is a historical chart just to show how the red, blue, and green lines, whether they're expensive, fairly priced, or inexpensive, how they have fared and how they behave at different times throughout market history. Another thing I want to bring up, and I usually don't cover this all that much in the intermarket analysis video, but I think that we're seeing something that's kind of powerful right now. And so I'm putting it in all the videos that I do, the daily, weekly, and the intermarket analysis videos, because we're seeing a real convergence of signals that shows that the markets are really shifting from being more value oriented, more into growth. Well, one thing that we look at is a while back when we hit that low, we were extreme negative with the percentage of stocks in the S&P 500 that are above their 200-day simple moving average. When that happens, we get an extreme reading. A lot of times that lines up with a significant low in the S&P 500. That's one signal we're looking at. Here's another one. This is the 10-day average of the highs and lows of the S&P 500. We had an extreme negative reading and we've been bouncing back up. And this can also mark either near or at a low in the S&P 500. Another scenario is that we saw a real spike down when we look at the American Stock Exchange, the NASDAQ, and the NYSE together. We take a 5-period moving average of the spread between the highs and the lows. And we were really negative and we've been bouncing back up since then. So that's another positive setup. Another one is the 5-period moving average of the equity put call ratio. We spiked up, which meant there was a lot of fear at that point, and we don't get above that level very often. Well, now that we've been going up with the S&P, this ratio has been going down. And again, a lot of times this can mark either near a low or we're at a low in the S&P 500. So that's another positive setup. The one that I'm kind of really focusing on right now, and I have to cough, sorry about that, is the sector rotation, where at the end of 2021, the S&P was making higher highs, but we saw the growth areas start to make lower. They started to diverge negatively. They were going down as the S&P was going up. A while back, about the middle of June or so, when we hit that low, we've been seeing a shift from value going back into growth. The QQQs are outperforming the SPY. Now, we went down a little bit on Friday because we had a down day. Discretionary has been doing a lot better, even though it was down on Friday. And the growth versus value is also still positive, even though it declined slightly. We're watching this moving average. As long as we stay above that moving average, that's positive. As long as the moving average itself is going up, that's also positive. And that's what we're seeing with all of these charts. The same thing with the next charts. These are large, mid, and small caps where we're above the moving average and the moving averages are going higher. So this is another positive setup. Another one, this one isn't quite as strong. We're waiting to see if the 2-year yield will spike and then start coming back down. When that happens, that often signals either an intermediate to short-term low in the S&P 500. Those of you that are shorter term in your outlooks on things, you might want to take advantage of this. Sometimes it leads to an even more significant advance. We don't really know at the time And we're not really sure if this is a valid spike because we're not very far away from that right now. If the 2-year yield goes up, it could take out this spike. So we just want to be watching that. Another thing are the staples. They had a really strong run up in 2020 and 2021. We've seen a recent death cross and we were going sideways. Well, they're starting to show some rebound, and this shorter term moving average, the 50, is starting to turn back up. But on a relative basis, when we compare them, we're showing the staples against the S&P 500 are underperforming right now. We seem to have had a spike right here, and we spiked at the same level before only to have it break down. But now we have a spike and this ratio is going down, and that often marks a low, a pretty significant low in the S&P 500. So this is another positive setup. And I'm bringing these up in all of the videos because I want anybody who's taking the time to watch these videos to see that and to see if that's a useful tool that you use to make some decisions in what you're trying to do. Nothing is absolute. Nothing, it's not saying that we're going to go higher from here. It's just we're seeing some positive things happening that you may want to keep an eye on and then use that in your own portfolio or in how you make decisions. All right, let's look at growth just by itself. This is a growth index where we've been in a real downtrend. This blue line is the 50-period moving average. This red line is the 200. We're below that, so we're in a downtrend, but we've been seeing a really nice bounce in growth pretty much since the middle part of June. Value, which has been the place to be for most of 2022, it is now declining. We have a recent death cross, and even though it bounced up, it's now starting to come back down. So these are independent indexes of each other. Now we compare the two. This is taking the growth versus the value, where growth had been declining and is now showing a bit of a recovery. We're still in a negative trend, where value had been really going up and is now coming down. That's still in a positive trend, but a shift could be happening. And then I have a lot of different charts to show this same concept, just using different tools. Here is where growth has really been declining in 2022, but now showing a bounce, even though the downtrend is still intact. This is the inverse. This is an inverse of that chart. Value had been going up, is now showing some weakness, and is still in an overall uptrend, but this could shift going forward from here, or it could stay the same. We could bounce back up and resume what we've been doing before. We can only evaluate based on what we're seeing right now. Another look is using a couple of ETFs, a growth ETF, which had been doing really well on a relative basis into 2020, had a little bit of trouble in 2021, but then a strong finish to 2021. It's been in a downtrend in 2022 when compared to the value ETF, but right now it is showing a nice little bounce, even though we're still in a downtrend. This is another look. This is an inverse. This is taking value, which had been really underperforming. It has done well in 2022 and now showing some weakness, even though it's still in an uptrend. Another look, the growth index against the value index, and we do a ratio between them, showing how growth has really underperformed, but is showing some improvement, even though it's still in a downtrend. Okay, then looking at some other markets, we have the 30 biggest software companies in the US. That's a big growth area and a large part of tech. It's still in a downtrend overall, but we're starting to see a bounce here. Can that continue? Also, looking at the CRB index, this is a monthly chart. It's still in an uptrend overall. And then we have, this was developed by Martin Pring. He has some inflation indexes that he uses and then deflation index that he developed, and this is a ratio between them. Now, this is a monthly chart, but this is just showing how, in a bigger picture look, how inflation has really been underperforming the deflation parts of those indexes. Also, the Commodity Research Bureau, the CRB index, still in an overall uptrend, but has been showing some weakness. Corn, just some things that are inflationary in nature, because when these go up, then that means you have to pay more. It really spiked up, has come down, and is bouncing up just a little bit. Here's aluminum, which really spiked up and has dropped, even though it's showing a recent bounce. Heating oil is still pretty high, but it's off of the highs that it were not so long ago. Gas, this is the one that's probably making people a little happier. We got up well over 4.2. We've dropped down now to 2.6. So the hope is that that will help folks who have to fill up their cars and cause the price of gas to come down, because that's something that everybody sees. And that's like an additional tax on people when gas prices really go up. Natural gas is still quite high and it's been bouncing around all over the place, but it is off of the highs that it set not so long ago. Oil has now dropped below 90. That's kind of positive also, and that can help feed over into the gas prices. Wheat really spiked up and has been coming down. Lumber has resumed its overall downtrend. It was in a strong downtrend, retraced that a little bit, and then is going down even more. The dollar, still in an overall uptrend, showed some weakness at times during the week, but had a really good day on Friday. Now, the thing that I've been saying in my other videos is if the S&P really does start to move higher, we're probably, not necessarily, but probably going to see the dollar go down in value, which is kind of another form of inflation. When the value of the dollar goes down, that means your dollar is worth less. And so you have to pay more dollars to buy the same thing that you're trying to buy. So the fact that the dollar has been doing well, that's helped a little bit. But if that really starts to go down and we're still in a pretty high inflationary environment, that's like a double whammy when that happens. Here is the euro, which has been in a pretty solid downtrend. It's bounced up a little bit against the US dollar index, which has been in a really strong uptrend, but falling back from recent highs. This is looking at the Japanese yen. The yen has really been having some trouble. The euro's been going down where the dollar's been going up. We're waiting to see how long is this relationship going to last, because this is strange over the last 20 years to have the dollar outperforming the euro. Now, is the euro going to come back and take over the lead? That's what we're waiting to find out. Here's copper, which is a barometer of the economy. It really fell. It's been bouncing back up recently, so it's showing some improvement. And I have to cough again. Sorry about that. Don't cough at all until I start recording these blasted videos. Here's a ratio between copper and gold. And copper just helps us to see what's going on in the economy. Gold is what people like to get into when things turn crazy. The only problem is gold hasn't been doing what a lot of people think it would do during a time like this. It should be going up, they think, but it's actually been going down. Now it's bounced up a little bit in the past week, but it isn't going to the moon like a lot of people have anticipated. But this is just showing how copper is underperforming gold, even though gold has bounced back up recently. We're still in an overall downtrend. This is that same chart, the black line here, just on a much longer scale going back to 1980. And then we compare that to the 2-year yield. And these are still very far apart from each other. Looking back historically, they tend to not get all that far apart from each other. And oftentimes they move in the same general direction. That's not what's happening right now. So we're waiting to see if that relationship will change. Here's the gold ETF, which is still in a downtrend. It's come back up to the 50-period moving average, but then was down on Friday. The same with silver, in a downtrend, tried to rebound, but has since been declining. Some of our different index ratios. Here's the CRB, which is inflation, against the S&P 500. The CRB is still in an overall uptrend, but showing recent weakness. Here's an inverse, showing where the S&P has been in a downtrend, but is trying to make a recovery bounce. Now what we're trying to figure out is, now we have some information on these scenarios to show us that this might be more than just a dead cat bounce, but you have a lot of folks that are convinced that this is a dead cat bounce. We could be wrong about this. This might just be a little blip up before we get set to go lower. There's something to be said for that. But at the same time, that big shift from value into growth could also be helping things. Here's the NASDAQ 100. This is growth against the S&P 500, which is growth and value together, where the NASDAQ 100 has been underperforming, but lately showing a nice little bounce, but still in a downtrend overall. Here's the mega cap ETF that we look at, still in a downtrend, but starting to bounce a bit. The S&P 100, which are the biggest stocks in the S&P 500, that hasn't really been performing all that great, but it's bouncing up, but it's not really showing a pretty strong rebound like we're seeing in some of the other ratios. Here's small caps, where they've been doing better lately, even though we're coming down a little bit. We have a recent golden cross here, and that can give support to the market sometimes. When folks are willing to get into the smaller, more riskier stocks, that means they're a little more adventurous, and that can help carry over into the mid caps and the large caps. And the S&P 500, of course, is what I focus on the most in what I do. Here's a ratio between the small caps and the S&P. That's this red line here. It's spiking up a little bit on a relative basis. And as I constantly point out, it spiked up before. And then after that, we saw a really nice run up in the S&P 500, not gangbuster run up. But if this continues to go up, that can also give some support to the S&P 500. The low volatility ETF, it's now in, well, we just had a recent death cross, but it's been showing a little bit of a rebound here. These are the stocks that folks get into, or the ETF that a lot of people get into when the market is starting to have trouble. They're not as volatile as some of the other stocks. Here's a ratio between the S&P 500 low volatility ETF, the ETF I just showed you, and the SPY, or the ETF on the S&P 500, where it has been in a downtrend overall. For 2022, it's been showing a nice little bounce, but has been showing some recent weakness. Here's the Dow Transport, Utilities, and the Dow itself shoved together into the Dow Jones Composite Average. It's looking a little bit better, even though it's still in an overall downtrend. Here's Dow Theory. And all I do with this is I just look at the Dow. The transports kind of look like they're behaving the same. How about utilities, where they saw some recent weakness, but lately have been showing a bit of a recovery, even though they had a down day on Friday. Here's a longer term look at that. We mainly look for divergences, either positive or negative. And then when things seem to be more in order, we settle on a convergence where they're pretty much moving in the same direction at the same time. Here's the FANG stocks, the really, really big tech stocks, in an overall downtrend for 2022, but has been showing a recovery. ARK also just getting hammered from its all-time high. It's still in a downtrend, but it's trying to hang in there these days. Looking at bonds against stocks, here's the total bond ETF, where we're looking at what could be a base right here, and bond prices are starting to recover. Here's a world bond index, where we went down to the COVID lows, set up a base here, and we've been trying to bounce up. Even though Friday was a pretty solid down day for the bond market, the employment situation report came out, and it was way stronger than expected. And this freaked out the stock market, although it did recover as the day went on. It freaked out the bond market, and they just kind of stayed freaked out for pretty much the whole day. That pushed bond prices down, which shot interest rates up. Here's a monthly chart of the stock to bond ratio, where stocks are still outperforming bonds overall. Here's another look at this with bonds against stocks, where bonds have been underperforming. Although we have seen a recent golden cross, this green ratio line here is starting to show some weakness. This is something that we're just keeping an eye on. This is the 10 to the 3-month yield curve. We have the 10-year to the 5-year already inverted. We have the 10-year to the 2-year already inverted. Well, the one that other economists use is the 10-year to the 3-month yield curve. It's been dropping pretty strong, but it hasn't gone inverted yet. So we're just keeping an eye on that. Here's the Dow Jones Corporate Bond Index, where some folks get into corporate bonds. Been in a downtrend overall, showing some improvement, but some recent weakness as well. Here's the S&P to the 10-year yield, where this just shows the S&P 500 has been underperforming the rise in interest rates, but lately we're seeing a little bit of a switch with that, even though we had some recent weakness on Friday. The junk bond index, which tends, or ETF, which tends to follow the stock market, it might have set some kind of a base and is coming up out of that. Folks get into junk bonds when they need higher returns. You're not getting much of anything with treasuries. So you might say, oh, I can get a lot higher return in a junk bond, but you're taking on a lot more risk when you do that. Here's a ratio of junk bonds to treasury bonds, and it shows how junk bonds have been outperforming on a price basis over treasuries. Here are the yields where we had been coming down overall, but that report that came out on Friday just really spooked the bond market, and we saw a real spike up in yields overall. Here's international, the yields on the 10-year, where the US has the highest yield here. Then you have the UK and Germany. They've been raising rates, but then they've come down. We still have Japan. They're in a different financial situation right now that I talk about in some of my other videos. And if this starts to really unfold, I might even do a separate video just about what's happening in Japan. But it's for different reasons why this red line is pretty much flat. All right, let's look at some sectors. The energy sector against the SPY, it had been the place to be for 2022. We're starting to see that come into jeopardy now. The blue moving average is rolling over. It's still in an uptrend, but if we break below the longer term moving average and then see a death cross, that could really switch what we see happening. But it hasn't happened yet. Here's the tech sector. This is growth, underperforming in 2022, but seeing a recent bounce. Semiconductors, also a big part of growth. Downtrend, but seeing a nice little recovery. The tech sector against the S&P, it had been underperforming in 2022, but lately has been showing a bit of a breakout, but we haven't seen a golden cross yet. Then some other areas that we look at, here's the growth area, or a growth ETF against bonds, where both have really suffered in 2022, but growth is now starting to outperform bond ETFs. Here's the 10-year yield against the tech sector, where the yields have been coming down before, but really have been rising in 2022. But now we're seeing a little bit of a shift there. But interest rates are still in an uptrend compared to tech. Here's the opposite of that. The tech sector has really been underperforming in 2022, seeing a little bit of a bounce, even though we saw some weakness on Friday. Discretionary, the things that make life fun against staples, the things that you have to have in your life. Discretionary had really been underperforming, but lately has been really showing some strength, even though we saw some weakness on Friday. Then here's the inverse of that. Staples had been going up, but now we're showing some weakness, even though they're still in an overall uptrend. Energy, the place to be, at least up until a while ago, against the sector. There we go. The tech sector, okay. Energy has been in an uptrend, but showing some recent weakness as oil prices come down. Here's gold, another thing that a lot of people get into when times turn crazy. That hasn't performed all that well. It's still in an uptrend when you compare it to the S&P 500, but we're coming all the way down to the lower moving average. If we drop below that, or this lasts for a long time, we might eventually see a death cross. Here's gold to the dollar. The dollar's been doing really well. Gold has been suffering. So we're in an overall downtrend, even though we've seen a recent bounce in the ratio between gold and the dollar. Here are high leverage loans. These are more risky loans that people get into. When the economy is doing better, people are willing to take on more risk. When it's doing worse, people kind of don't like to get in riskier loans. They're in an overall downtrend, even though we're seeing a bounce. Here's our InterMarket Analysis chart showing how oil is up 30% since the beginning of the year, and the dollar is up. All the other areas, gold, stocks, and bonds, continue to be negative, going all the way back to the end of 2021. Looking at some indexes, here's the S&P 500 with those stocks that are above their 50-period moving average. This is another positive setup. We went extreme negative and are bouncing up right now. That sometimes has marked a pretty significant low in the S&P. We're also seeing a confirmation with the mid caps. We're seeing the same thing, extreme negative and a recovery bounce. And in the small caps, extreme negative and a recovery bounce. That's a little more legitimate when we see this happening across multiple indexes. Here's the small cap index by itself, where it's been going sideways over the last week, but showing some improvement. Mid caps also going sideways right now, but showing improvement. And the Dow is also showing some improvement, but we saw a lot of sideways action. The NASDAQ, it's kind of been the leader. So on up days when growth is doing well, it's the NASDAQ that's in the lead. When we have a difficult day, it's the NASDAQ that's going down the most. So we want to be careful of those things. NASDAQ 100, also a growth index. It's been showing a nice little recovery lately. The Wilshire, which is more broad-based, it's been showing a recovery. All stocks, not only in the US, but internationally, still in an overall downtrend, but showing some recovery. Emerging markets, a lot of people really like to get into those kind of investments. They're still in an overall downtrend. And it's kind of hard to tell if they're really basing. We're not seeing any kind of a breakout yet. Here's an international look. China is in a downtrend where you have emerging markets in an uptrend. Europe, Japan, and the US are now in uptrends overall. China's kind of its own thing. They're a big market, but they're not a real influential market as far as how they impact Europe and the US, unless something really, really big happens that freaks everybody out. Some correlations. The S&P 500 to the dollar, they still have a fairly strong inverse relationship. So that's what I've been watching. If the dollar's up or down, typically the S&P is doing the opposite, but we're seeing that relationship not as strong as it was just a few days ago. Here's S&P to oil. It had been mostly neutral overall, but now we're starting to see them move in opposite directions. If oil continues to fall and the S&P continues to go up, you'll see this relationship get stronger. Here's S&P to the 10-year yield. Also, still going in opposite directions, but not as strong as it had been. And here's the tech sector to the 10-year yield. Also, opposite directions, but not as strong as it was. Here's the S&P to the 2-year yield, where this is neutral territory. When we get into 0.25, minus 0.25 to plus 0.25, I call that neutral. We could be breaking out to where they're going in the same direction. We'll have to see how that goes. So there's been one update on here. Those things that are positive still include energy, even though it's had a real difficult time recently. It's still in an overall uptrend. The CRB index, the same thing. It's been showing some weakness, but the uptrend is still intact. And the same thing with interest rates. Now, on the negative side, these are if you've watched any of these before, this is the same list, but I added gold to this list right here, where all of these different, mainly stock areas, are still in overall downtrends. And even Bitcoin's been having some trouble. And here's gold. I added that to the list this time. And staples are still looking more negative right now because of that recent death cross. So thank you. I hope you found this useful. Please feel free to check out the daily and weekly videos that I do. I update our scenarios every time I do one of those videos. So if you find that something that is useful to you to make decisions, please feel free to make use of that anytime you'd like.